Welcome to the source of commercial real estate, where we talk to the experts in non-residential commercial real estate so you can grow your business, find a competitive advantage, and use real estate to live the life that you want. I am your host, Jonathan Hayek, and today I am talking with Dennis Cisterna. Dennis is the co-founder and chief investment officer of Sentinel Lease, a privately held commercial real estate investment firm. He's also the founder and chief executive officer of Guardian Residential, a privately held residential investment firm. Dennis has held a wide variety of management positions within the real estate investment sector, including key roles at notable firms such as Johnson Capital, Lennar, and Toll Brothers. Throughout his career, he has completed more than $3.8 billion with a B dollars worth of real estate transactions across the U.S. and Europe. Dennis, I am thrilled to talk to you today. How are you?
I'm doing great, Jonathan. Thanks for having me.
Perfect. Really looking forward to this conversation. Why don't we start out by you telling us about your background, how you got into real estate, and what your work looks like today?
Sure. I'll try to make it quick since it's been like 24 years and change. But started out in college. I thought I was going to go to law school, worked on a political campaign and realized all the money was coming from real estate developers. So I used a couple connections I had to get an internship at a consulting firm that specialized in real estate feasibility studies and housing market analysis, and started there out of college. Worked my way into a full-time position, and really just I fell in love with all facets of real estate at a very early age. Definitely worked my way up the corporate ladder. I thought that was the way to go, even though I've always had an entrepreneurial bug. So worked as a housing market analyst and consultant, went into acquisitions and project management with Toll Brothers and Lennar. Housing market exploded. Went into investment banking for about 8 years, raising capital for all types of real estate, including single-family development, office, retail, self-storage, hospitality, you name it. And then transitioned that into working for Service Capital Management on the lending side of things, lending on SFR portfolios, really being one of kind of the early entrants in that space, doing the first multi-borrower securitization, and then went into a technology and investment company called Altisource, and finally made it to a CEO position for one of their business units, and it's just not all it's cracked up to be. You're still working for somebody else. You don't make all the decisions. The upside financially is limited compared to what you can make on your own. And so after almost 20 years in the industry, I stepped out and started my own firm, Guardian Residential. We focused on model home sale leasebacks. It's an off-balance sheet financing solution for home builders. And then I partnered with a friend of mine in the SFR space, and we were one of the early entrants in the build for rent sector. With Lafayette Communities, and luckily sold all that portfolio right before interest rates got really crazy. So we started Sentinel about 3 years ago. We focus on mainly single tenant net lease deals, mostly office and retail, but we're fine, taking on industrial as well. But we're very value oriented buyers. I like to call it advanced coupon clipping. So, if the market, if your money market account is going to pay you 0, I'm going to pay you 8. If it's going to pay you 5, I'm going to pay you 12. So that's it. And we syndicate all our equity for this platform. We've got about 300 million under management across 18 properties, close to 2 million square feet in about a dozen states. So it's been great to grow the platform, and I'm like everybody else trying to make sense of what's next for the market right now. I read more research and data publications than I ever have, which says something for a guy that's a former housing market analyst. But that's in a nutshell. So we're, my day to day right now is really sifting through literally probably about 100, 150 deals a day, trying to see if anything can make sense. But unfortunately, the bid ask spread between what a buyer can afford and what a seller wants to sell it for is pretty wide right now. So, a lot of picking up a lot of pickleball with my spare time.
Dennis, I want to zoom in on your work with Sentinel Net Lease. You have tons of experience all over the real estate and finance world. Let's zoom in on Sentinel Net Lease. You touched on uh, some of the properties that fall within your buy box. Tell me a little bit more about who Sentinel Net Lease is and what types of properties you're focused on.
Sure. So when we started Sentinel, my partner Fred Lewis and I, we were frankly just looking to deploy some family trust money for the two of us into something where we could just park money for a little bit of a while and hope for a decent deal. And we didn't really know how the universe was positioned from a cap rate perspective, anything else. So we were kind of first looking in the $3 to $5 million range, and this is like Starbucks and Walgreens, and frankly, the yields suck. The price per square foot that you pay is phenomenally high, right? It's like $2,000-$3,000 a square foot for a building that cost maybe $300 to build. So we didn't like the value proposition there, and we started looking up a little bit into the middle market. So let's call it 7 to 20 million. And what we found was that market was much less commoditized. It was much less populated by 1031 investors who, with all due respect, I do not consider to be the most sophisticated investors. It's really obviously kicking the can down the road for taxes is the main priority. So sometimes they're not always buying the asset at the right price. So there's a lot less competition from 1031s. The assets are less consistent, right? It's not just a chain of a retailer or a service provider. It's office, it's big box, it's a lot more variance in the type of assets you're looking at. And so with that, we saw some pricing miscues where we did not think the brokers, the sellers, whoever was pricing the risk appropriate on the deal. And so that's really what we're looking for is basically some kind of spread against the market where we can still go and find accretive debt on the deal and produce a nice cash on cash return, and still have a basis that we think is below the market and almost always below replacement cost.
Dennis, it sounds like you're looking for properties that have some upside but aren't huge, heavy lifts. Like, it doesn't
Yeah.
sound like you're buying vacant properties and leasing them up. It sounds like
No,
you're looking for mispriced assets.
that's right. So, most people will kind of fall into three camps of how they're going to create value for the asset. Either they're going to build it from the ground up, they're going to add some value add element to it from renovation, leasing, or they're going to look for more of an opportunistic buy. And opportunistic buys are difficult to come by when you're not in areas of great distress. So it is a bit of a needle in a haystack philosophy, but it's out there. And we could have grown the platform a lot faster if I was interested in kind of just generating a little bit lower return. But because it's obviously our own money alongside all of our other investors, we're patient capital to find the deals that we think make sense in the environment we're in. So we're trying to make that money. We're trying to have that imputed equity on day one where we feel like we bought it at the right basis. But yes, if you look at the total return profile, I would say 50 to 60% of our overall projected returns come from in-place contractual income, as opposed to a lift that's going to occur from increasing rents or increasing vacancy, or as many multifamily syndicators do, assuming there's going to be some massive spread between what they bought it at and what they're going to sell it at. So in most of our disposition analysis, if I bought something at like an 8 cap, I'm assuming I'm going to sell it at maybe a 7.5 with a slightly better term. Like, the economics don't really change. Where, as we're seeing on multifamily, there's a lot of a wish and a prayer mentality going on right now, where guys are a bit exposed at the moment on floating rate debt, and there is no savior there. Interest rates aren't going to drop like a stone over the next 12 or 24 months, so it's going to be problematic for a lot of those folks.
Dennis, the first deal that Sentinel Net Lease did was pretty interesting. It was the tenant is Amazon,
Right.
and It was in a small market in West Virginia. Can you kind of take us through that deal and what you liked about that deal?
Yeah. Well, I didn't like the deal at first because it's in Huntington, West Virginia, and the only thing I knew about Huntington was Marshall University and methamphetamines. So it wasn't exactly the one-two punch I was looking for our first foray. But um, as we studied the deal a little bit more and had started our diligence, um, it started to check off a lot of boxes that a desktop underwriting would never uncover, right? So obviously we go out to the site, and we meet with Amazon. One of the things we do when we buy something that's in a anything other than a major city. So if it's in a suburb of a big city, we're going to go meet with that city's mayor. In Huntington, we met with the mayor, we meet the economic development people, and we really try to understand the narrative of why does this property exist? Why is this company here? And do you guys even care about it? Well, with Huntington, it's a crazy story, but one of Amazon's real estate people, his wife grew up in Huntington. They were back home visiting the family. The pastor was over there. The pastor, the family's pastor, made a hard pitch to the husband and said, "Hey, you guys should really think about bringing Amazon to Huntington. We would roll out the red carpet for you." Blah blah blah. And frankly, they got it in motion, and that's what they did. Huntington already had a bit of a call center presence, and they did this joint presentation between the city of Huntington and Marshall University, who said, "Look, we're putting a training program specifically for your workforce if you guys are to relocate here." And that was, I don't know, that was like 15 or 20 years ago, and they've been there ever since. They started in a building downtown, then they had this build the suit that they're in now. And the scariest part of that deal was it was right when COVID was going on, like right when it was starting, right when things were getting shut down. And we had already completed our diligence at this point, and we were in line to close. This is like middle of March 2020. And like 25% of our investors just disappeared, right? They're just like, nope, I'm spooked. I don't know what's going on with the market. And we just, you know, we took a real hard look at the deal and we said, if there's one company that's going to be okay during a place when nobody can go outside, it's probably Amazon. And that's kind of how it worked out. And so we walked our investors back into the deal and picked up a few new ones along the way, and were able to close at a time when literally I think we were like one of the only closings in America the last week of March of 2020, and that kicked things off for us. And from there we bought a lot of, you know, what we consider to be mission critical and essential use stuff. So our next couple of deals were grocery stores in Midwestern markets, and we've continued to grow the portfolio from there.
That Amazon deal, is it like an office call center?
Yeah, it's an office call center. So it's not a big warehouse. It's a 65,000 square foot building in a great location in a business park.
And do you remember how you found that deal, or at what part of the process did Sentinel come in, as it was being marketed?
Yeah, so it was an on market deal through CBRE. I had known the primary broker through a previous relationship, and so that actually was probably more beneficial than not having that broker involved in listing it, because we were a startup platform at this point, right? We had no other than kind of the track record of myself and Fred as professionals with our other businesses. Sentinel had not completed a transaction. So having this broker vouch for us to an institutional seller was essential, I think, to kind of landing the deal, because in any environment, certainty of close is very important to your seller. They don't want to waste time or capital. So that really helped. And the way we source our deals today, we obviously still rely on a lot of great broker relationships, but we also proactively do outreach to a number of owner occupants of buildings, as well as other institutional owners that are, that we know are sellers at this time. Like a big announcement that a few days ago was WP Carey is big. They're a big REIT. They're shedding all their office assets essentially. So, so we picked up a phone and shot an email to the folks we know over there and said, "Hey, look, we're interested. Maybe there's something we can do." strategically here, where obviously we're not big enough to take down, a sizable portion of the portfolio, but we probably could pick off a couple assets.
So your first deal was an office deal. I saw recently on your LinkedIn feed that you have closed or are closing several other large office deals right now. So
Yeah,
sounds
I'm,
like
I'm a bit,
you.
I'm a bit of a contrarian on that
Yeah,
front.
so let's hear it, because a lot of people hearing this will think that you're crazy for taking down
Um,
these big office buildings. So tell
yeah,
me
so,
about your philosophy.
no, I get it, and I probably agree with their sentiment on a lot of stuff. Not that I'm crazy, but that there is um, the prevailing winds for office are not good overall, which I agree, and I think that's where the opportunity has really come from, because what's happening in that sector is you're saying office and you're saying bad, and if you say all office is bad or all of anything is bad, well then you're missing some of the nuances in the industry, right? So number one, we don't touch anything in the central business districts. I think the long-term effects of these so-called doom loops that a lot of downtowns are starting to go through right now, where there's no office population and the retailers and restaurants are suffering, I think that could be problematic for a long time, and not something we really want to get involved with. Never mind that it's always a little harder to do business in big cities than small cities or suburbs. We like the suburb locations. That's where our entire portfolio is in the suburbs. So we like that in a lot of areas throughout the country. The suburbs have really changed that mindset of just, I don't know, country clubs and long commutes. We're in areas where people have 5-minute commutes to their houses. They've got amazing commercial services and restaurants and healthcare nearby. And obviously it's more affordable to be in those areas. So our basis in most of our buildings, is between $100 and $150 a square foot, which is well below replacement cost. Um, Overall, office does have some serious challenges ahead for sure. I think that's why when you look at the deals that we're acquiring now, they're deals that have long-term duration. The deal you just mentioned, we just bought an insurance company's headquarters in Davenport, Iowa, which is a couple hours west of Chicago. In that situation, they have more than 8 years of lease term remaining. That building has true physical utility. You go in there, the desks are full. Now they don't work 5 days a week; they work 3 or 4 days a week right now, and they're like, "Look, as soon as we can get everyone back every day, we can." But there's a fundamental issue right now that we have a labor shortage going on, and I think more than any time you've seen in the past 30 or 40 years, there is a leverage that the employee has that they have not had for a very long time because of that, which I think has helped delay kind of the return to work mantra. There's a lot of companies we've talked to that were supposed to be 100% occupied back to the office now, and they still have a hybrid schedule at best. So it's certainly a challenge on that front. But the properties we're looking for are the ones where they are in the office, and it's part of the job to be in the office. No doubt that you can do a lot of jobs from home, but there's also a lot of jobs that don't perform as well when you're at home. A good example of that is like an engineering firm or an architecture firm, where that collaboration is important. The mentorship is important. And so, one of the buildings we own in Kansas City, in a suburb called Lenexa, it's a headquarters to GBA, which is a large engineering construction management firm. That place has been packed since a month after COVID started. So we see that utility in the office. And when we know we can buy it at a nice discount, when we know the rents are affordable relative to the rest of the market, it puts us in a good spot where you're going to go buy an apartment building and it's going to earn you a 5% cash on cash, and our building is going to earn us a 12. And so the only way you're going to get out ahead on your multifamily deal is if interest rates decline, right? Or you're going to have massive rent appreciation, which unfortunately that kind of already happened. So I wouldn't bank on too much more of that. So the only way for you to kind of make any serious return as a multifamily guy, and industrial, unless you're developing ground up as well, things that where there's an ultra low or even negative leverage being used on the debt, you're betting on the come. You're betting on something that's going to happen that you have zero control over. which is just madness to me. It's the first thing I was taught not to do as an investment manager. So on this, yes, I'm making a contrarian bet, but I'm making a contrarian bet where, like as an example, on the Iowa deal, we're getting 82% of our money back from just the lease in place right now, right? We're really de-risking the investment from the beginning because we have this contractual income from usually investment grade, credit rated tenants where the default risk is de minimis.
You've alluded to debt a little bit. I want to ask you about what kind of debt you're getting. There are some operators in the space that are closing with cash in order to get better deals and refinancing after the fact. Tell me about your philosophy on debt and what your debt structure looks like right now.
Sure. Well, it's evolving. So by the time this is published, it may not be it may not be accurate, but I would tell you, generally speaking, right now, we're actively bidding on a lot of retail, uh, office, and what I would consider to be special use, kind of auto dealerships, showrooms, things like that. Um, and so for that universe right now, most of the debt you're going to see is between 50 and 60% of your cost. It's going to be priced probably somewhere between 225 to 300 basis points over the 5 or the 10-year treasury, assuming you want perm debt. So you're looking at an all-in rate north of 7% pretty normally. And so we only do non-recourse debt as a syndicator. It's total misalignment to do recourse. Um, and so most of our debt that we've originated has been through large and middle-sized credit unions and banks. I hate CMBS debt. We could do an entire episode on why I'm not a fan of mortgage-backed securities for an operator on a variety of fronts. No disrespect to my CMBS friends because I worked for a lot of them and I was a lender on that side for a while. But I think the advance rates are down. The duration has to be there. Like I can tell you on the office side of things, most of my lenders want to see a lease term of at least 2 years longer than the loan they're going to give. So if it's a 5-year loan, it's at least 7 years of lease term, which is fine because we're not looking for anything really at this point for under 8 years anyway. But that pricing is tough, and the problem is the money is still not there, even at those terms that are tough to swallow. So, a lot of people have just closed up shop right now in terms of their new origination. So the pipeline for that debt is there, and as you might imagine, when you're getting debt that's 7.5%, you have to be able to hit a debt service coverage ratio that makes sense. You are either taking practically no leverage, or you're buying at a cap rate that is phenomenal, and that's kind of where I'm at right now. My average bid going out right now is close to a 10 cap. So it's I'm not winning all those deals, but I have felt a shift in the last 30 to 45 days where that pricing is starting to get me a second conversation with people as opposed to them being offended because I don't know what they're being offended for. They're not selling it at their number anyway, right? So, the debt market is totally tough. I think that the investment sales market is a challenge too. They're just kind of going hand in hand. I think for anyone listening right now, I will tell you one thing that I did, and I learned this when I was an investment banker, and I would place debt for some of my clients. I literally go get there's lots of websites out there that will show you a bank that has a branch in every state, right? And you literally go and you work through LinkedIn and you find out who their head of originations is or the head of the real estate lending department, and you just start dialing for dollars. And so on our average deal, we contact between 125 and 150 different lenders.
All right. I'm letting that sink in for a second. I want to talk a little bit more about your debt because you do have kind of a unique debt structure in that you're doing all non-recourse deals, and that's pretty rare in the non-residential space. A lot of loans, especially you talked about kind of medium-sized regional banks, credit unions. A lot of those that I talk to will only do recourse,
Absolutely.
full recourse. So, can you talk a little bit more about the negotiation process? You're reaching out to over 100 lenders per
Yeah.
deal. Are you using brokers? Do you just have a Rolodex from your background? Tell me more about finding debt.
So we create we for a new deal, if it's in a market or a state we haven't been in, we'll create a new Rolodex for that. Obviously, you can go to national lenders or people that you know have a footprint there. But on top of that, we'll go to man. If you go to depositaccounts.com, you can look at the largest banks, and I can't believe I have this up on my website or on my browser. But if you go to depositaccounts.com, you can go by banks, and then you can sort by assets, the assets they have deposited, and then you can sort by state, right? So that's your starting point for anywhere. And then, if you're, depends on the loan size you're doing. Most of our loans are $10 million or up. So we're not really bothering with banks that don't have at least 500 million in deposits. And so we'll have that list. We'll say, okay, these are the banks. We don't use brokers. We do everything internally. Just because I've done this before. I don't get me wrong. We've got a lot of great great investment bankers, mortgage brokers that I've worked with in the past. But we just know how to do this, and so we use some of our junior staff to just run through all the legwork here. So we use a tool called Zoom Info, which is basically just a big population database. So if you want to know the information for someone, it's not cheap, but if you don't want to hunt and peck through LinkedIn, it's basically you type in someone's name and it's going to have kind of their whole employment history, their cell phone, everything. It's just a big data aggregator for people. So that fast tracks our ability to get to the right person within the lending institution. And then from there, it's just kind of calling them, sending them emails. We obviously prepare a debt summary for each of our deals, and we start working from there. And Jonathan, you're 100% right. Like, so many of these guys do not do non-recourse loans, but the only way you're going to know is by asking. So it's it's kissing a lot of frogs is the way it works out. But that's, at the end of the day, we have a handful of lenders that we've worked with that are phenomenal. Even in this market right now, they're kind of like, look, we know you underwrite well. We know you guys are buying at the right basis. So, let's keep sending us deals. And so the only time I've really had a problem is if I've reached my limit with a lending institution, then I've got to go look elsewhere. But it's definitely a challenge. You've got to be dedicated to doing it, but it's worth it, right? I mean, what is the alternative? Buying something cash. Buying something cash makes a lot of sense to me for people that are long-term legacy buyers of something and don't really need the debt to buy it, but that is not the majority of real estate investors. So if you are going to use debt, I think you owe it to yourself to go out there and explore all the options available.
Dennis, can you talk more about when you make this initial contact with a lender? Say it's a lender you've never done a deal with before.
Sure.
You've never talked to them before. They don't know you. You don't know them. What are you presenting them with? Do you have like a whole pitch deck ready? Do you have your personal financial statement ready? What in those initial conversations are you presenting them with so they take you seriously?
So usually we'll just present them with a corporate overview, which is like a 12-page deck that we created that just says, look, this is who we are. This is our portfolio. These are the other lending institutions we've worked with. And this is kind of our general investment strategy. And we'll send that kind of as an intro and say, look, we'd like to start a relationship with your bank, because I think banks do want relationship borrowers just as we want relationship lenders. So I think that part comes across as very genuine, because that's true. I don't want to go out and call 150 banks every time. I just feel like I owe it to myself and my investors to do it. But there's a lot of times I've done that, and I've gone right back and done the deal with the lender I knew from the very beginning, right? So and it's because I need to trust that process. The times that I haven't done that, it hasn't always gone the way I wanted it to. So, it just starts with that. It's a simple email, or a phone call, and just explaining, hey, look, we're this company. We've got a lot of assets under management. We're looking at acquiring an asset in your state. Are you guys open for business? And can we have a conversation? So it's not like you got to beat them over the head. It's really a binary answer. Yes, they might lend to you, or no, they won't.
I want to transition into a little bit more about your background and how you're leveraging your background to uh, to contribute to the success that you're having today. Sentinel has bought hundreds of millions of dollars worth of real estate just in the last couple years alone. You take on passive investors. You have over 13,000 followers on LinkedIn. You have a really impressive background.
Thank you.
Your network must be vast. This is coming from me, someone who I have a teaching background. I do not come from a high net worth family. I don't have high net worth friends or acquaintances. So, can you talk a little bit about how I don't want to say leverage is maybe a bad an unfair term, but how are you using your background and your network and your connections to build your investor database and close these good sized deals that you're doing right now?
Yeah. No, look, that's a great question. I think I think because I realized at an early age, even in college, and I did not come from a wealthy family at all. I'm in the middle of buying my parents a bathtub for their place right now. So, it's, it's not something that I was born into at all. But I've always been very passionate about it. And I think I realized in college how important networking was. Um, I got my first job in college. I worked at like a golf logo company. Like they made golf products with logos, like for NFL teams, stuff like that. I got that through a fraternity brother of mine. I just realized that, wow, you can really leverage these connections to kind of get an extra step you maybe couldn't get on your own. Same way I got my internship in the consulting and advisory firm in the very beginning when I was in college, and I immediately joined a bunch of organizations, like National Association of Home Builders, Urban Land Institute, just to be out there and talk to more people. And, hopefully some people would mentor me and give me good advice. And that just has always been a big part of it. Started attending conferences, and then I got to speak at conferences, and it's always been I would just say it's a natural progression of just kind of constantly keeping your foot on the pedal, and being nice. I think that's a little underrated now. But being nice to people and spending time with them, even if it doesn't necessarily benefit you at that second, goes a long way when it comes to networking and building trust. And so, even before I launched my firm on my own, because I was nervous to do so. I mean, I think I had PTSD after the Great Recession. Um, I had a couple of colleagues of mine in the industry that literally said, "You are too freaking smart to keep working for other people. Like, what is it going to take to get you to go do this?" And finally I realized. I was like, okay, I have some money in the bank. What am I waiting for? Like, what am I afraid of? What's the worst that's going to happen? Worst case, I flame out and I go back and I'm still an executive and I make a decent amount of money, and that's at least I know I didn't have it as an entrepreneur. And then, when I started it, I tied my first deal up, and I mean, I did an old school roadshow. I mean, I got on a plane and I visited friends, and I was raising the money kind of handshake by handshake. Um, and it just, that gave me a ton of confidence too. After I had raised the money for my first deal, it just gave me a ton of confidence. Like, okay, I'm really doing. I closed on an $11 million deal. I started my company like 5 months ago. This is pretty cool. And I think from then it's just constantly learning and evaluating and growing, how how you can take advantage of everything you've excuse me done in your past, and what you continue to bolt on. Like I'm a very good marketer of the things I know, but I'm not a good generic marketer. Like I don't I frankly I am learning how to go bring in people that don't know me into our investment platform, right? And I don't want to be a Grant Cardone or one of those dudes. Like I don't want to be a larger than life personality huckster. With all due respect to whatever they do, I mean, there's a place for that in society, but I kind of want the deals to speak for themselves, not for me to speak for the deals. And so that's really important to me going forward. But it's tough because a big part of marketing is your personality, and it's not the deal on it, by itself. So that's something I'm struggling with now to figure out what that right balance is of how much the opportunity should speak for the platform versus me.
Dennis, we're getting towards the tail end of our conversation here. I have a bunch more questions, and it's okay for these to be quicker answers, but I think they'll give us a really good idea of kind of how you see the real estate market
Sure.
right now. So, first up, what market are you excited about right now, and why?
Geographic market.
Geographically.
Um, I like the South. I like the South for the growth. There's a lot of markets in the South that have great growth story, as long as they can remain affordable. When they get a little too hot, I think there's a tipping point, and the problem is because those growth markets add so many housing units or so much new square footage of commercial real estate, it can get hit pretty hard if things slow down abruptly, because then you're going to have an overhang of supply. But like I like Jacksonville, I like Orlando, I like San Antonio. Um, I like Omaha. There's a number of Midwest markets. If you look at our portfolio, um, I think there's an inherent value in places in the Midwest that are stable or growing, and that have an extremely high quality of life and affordability. So there's a number of markets there. Omaha, as I mentioned, Kansas City, Oklahoma City. I was shocked when I visited Iowa. It's a very small market. It's not a place I would, plan on putting $100 million into. But this area in Davenport was bustling and had a lot of redevelopment and a lot of new retail. And I like the energy there when you can feel a city is steering their area in the right direction. I think that's a very important part of whatever market you go into. If there's a certain amount of NIMBYism or anti-growth measures, like Chicago is so oppressive, the city of Chicago proper. Now, if you go into some of the suburbs, like we just bought an office building in one of the north suburbs, it's a great village. They're easy to talk to. They're easy to do business with. We own a Tesla dealership and another one. But I don't want the cost of doing business somewhere to be brain damaged. And so that's why we generally will avoid like the downtown areas, or even these suburbs if they're in the city lines proper.
Dennis, what does a great deal look like for you today?
A great deal right now, I will tell you, we kind of have refined it. It is pretty simple. I'm looking for a deal that has at least 10 years of lease term remaining, Fortune 500 company, and I'm buying it at a 9.5 cap or better. If I'm doing that, I'm getting back like a 130% return on my investment just from contractual lease income. And I think I'm buying at the right basis, that as long as I have flexible debt that doesn't have some kind of onerous prepayment, if the market if rates do go down at some point, I'm not banking that they are anytime soon, but if they do, then my basis would allow me to sell and still have term on the deal. But I'd be fine clipping a very strong double-digit coupon as well.
What's your top tip for finding deals right now?
Use technology. Your network is a great place. Don't get me wrong, but your network is less powerful to finding deals than technology is. And so that is a big part of it. There are, like, we do a lot of things internally where we will go onto CoStar, right? And we'll say, all right, we like San Antonio. Let's see who owns every every grocery store in San Antonio, um, and see if there's a company that has a company that's owned it for a long period of time, and then just kind of slicing and dicing and doing some outreach that way. Um, the broker relationships are important. You can't ignore the brokers for sure, but I think that extra step is going and doing a lot of mass data analysis and then a lot of mass marketing. It really is just a numbers game. I mean, I'm sure a lot of your investors are probably localized into a singular market, and those guys succeed because they know everybody in that market. And for a guy like me that goes to multiple markets, um, you can't have a guy in every single market, or I mean you can, but I'd rather just use technology to kind of narrow down my prospects and obviously keep my overhead low.
What's your top tip for raising capital right now?
That is a great question. Number one, I'd say you absolutely have to have conviction in what you're doing, and the deal has to make sense today in this environment. If you the majority of your profit is based on speculation on things you can't control, you're going to have a hard time. There's a reason that investment volume overall is down nearly 80%. And that's because, smart money is not deploying capital unless it makes sense today, right? So, and it's same for us. I've only bought 2 deals this year. And we only bought 3 deals in 2022. It was 2021 when I was buying deals at an average of almost an 8.5 cap, and I was borrowing at 3.5 cap. That kind of spread is, so we bought 7 deals or 8 deals that year. If I saw more deals that would work, I would go out there and buy more. But I think if you're going to go raise capital, it's very important to understand. Number one, the deal's got to make sense. Number two, you have to understand what you're competing against in terms of returns, right? So you can go get a money market, a high yield savings account, and earn over 5% just about anywhere right now. So if you're going to go offer a pref that's 6.5 to an investor, and none of that is even current pay, it's all speculative. It's a lot tougher. It's a lot tougher run, especially if the investor doesn't agree with your underwriting or your exit.
Finally, Dennis.
Was that advice, or was that just don't do that? Sorry.
No, I think I personally connect with a lot of what you're talking about. 6 to 12 months ago, I saw a lot of underwriting that was banking on interest rates going down really fast. And, it was just not grounded in reality. And, we'll see how those deals do. But I totally agree with you that deals have to make sense under current lending terms and not under hopeful lending terms.
Right.
That rates may or may not go down. They may go down next year, probably not. But if they do, hey, just count that as a bonus.
Right.
Dennis, finally, is there a book, a podcast, YouTube channel, or a resource that you would recommend that has been helpful to you?
I read a lot more of daily publications now than books.
Mm-hmm.
The book I'm reading right now is, am I doing that the right way? There we go. Gulf Capital and Islamic Finance. So
sounds like a heavy read.
Yeah, well, it's not something that I don't have any exposure to. I've never raised capital from that environment. I don't know much about Sharia law, but it's something I'm very interested in. I think I will tell you, between that and Khan Academy, I know it sounds very basic, and it's probably for most people's kids when they want to learn a subject, but I find both of those things to give a good way to understand something that maybe you don't. Other than that, I'm a big fan of just kind of quarterly publications that are produced. I'll give you a great example. If you go to cbre.com, their research department is phenomenal. They produce such great they do market reports anyway, right? But who gives it what the vacancy rate of industrial is in Toledo? That's not quite a game changer. But if you want to look at what how much money has Canada invested in the U.S. now versus 5 years ago, or overall investment volume or lending momentum, there's a lot of great real estate specific macro trends and data in there that you don't find in a lot of other places. So Being a bit of a data geek, I find their reports, and you can subscribe to them. I find those to be highly valuable.
Dennis, I have learned a ton from you today. I could talk to you for several more hours just about your background and how you see the commercial investing world. If listeners hear this and they want to connect with you, they want to learn more about Sentinel Net Lease, where would you like to send people?
You can go to our website, sentinelnetlease.com, or you can send us an email, info@sentinelnetlease.com. Either one of those is fine. And just mention the show. And if you want to talk to me, one of the things we have for our platform, Jonathan, is we're pretty transparent and accommodating. So like I talk to all of our investors. It doesn't matter if someone's invested 25K or 2 million. Like I want everyone to feel comfortable. And if they don't want to invest, like I'm probably the worst salesman ever. Like if it's not for you, okay, cool. No worries. I don't want anybody to do anything they don't want to do. So, but I have a lot of conversations with people about the market, give them advice as well. I'm not a coach or anything like that, but I'm happy to give my time to people if they're interested.
Well, I think that philosophy is working out for you because you've done you've done a ton of deals and you're raising a whole lot of money. So something must be working right for you, Dennis. I want to thank you so much for your time today. Thanks for your generosity of time and your generosity of expertise.
Thanks for having me, Jonathan. I really appreciate it.
Listeners, thank you so much for listening. If you enjoyed this conversation, please reach out to either one of us. Reach out to us by email or LinkedIn. We would love to connect with you and talk to you about commercial real estate. Thank you so much for listening. Until next time, take care.